So good afternoon, everyone. Thank you all for coming. I'm hoping that we'll have a good discussion today. Before we jump in, I'm just going to say that the views I'm sharing today are going to be my own and not reflects those of the Federal Reserve Bank of Boston or the Federal Reserve System. Okay, so jumping in now, we're already on slide one. Just to start, I'd like to set the stage for our discussion today with some perspectives on the recent behavior of Treasury yields and what might be driving this behavior. So the first chart here on slide one shows movements in 10-year yields for a few advanced economies over about the past year through, I believe, the first week of November. So as you can see, yields in the US, the UK, and German yields have all risen about 1 percentage point over this year, with Japanese yields up by a little bit less, but nonetheless, all advanced economies have seen some run-up in yields this year. One of the reasons that I think the rise in the US yields might be particularly salient now is that unlike some of these other countries that have seen more gradual increases in yields, the rise in the US was almost all concentrated in the latter part of this year. Though yields have come back down by a fair amount over the past few weeks, they increased by just over a full percentage point between the beginning of July and the end of October. Interestingly, I'll note a period over which the policy rate has largely been on hold. And so market participants and market watchers have given a wide variety of potential explanations for this run in yields. On this slide, slide two, I'm showing the responses from the most recent October edition of the New York Fed surveys of primary dealers and market participants. So respondents were asked to assess the importance of various factors in explaining the increase since July in this is the five-year for nominal Treasury yields. So it's really kind of focusing on the longer end. The answers were, as you can see, all over the place, with a number of explanations like interest rate risk, the fiscal outlook, and in the first column, the perceptions of US potential growth, all receiving relatively kind of equal weight in the minds of these participants. And I'll say that this change in perceptions of US potential growth, I think could be related to the concept of the long run neutral policy rate, or R star. Other market intelligence collected by the New York Fed that's available to us internally also, I think, broadly reflects a belief that there was not a single factor that was most obviously driving yield movements during this period. So there's a lot of disagreement, and I think good reason for us to have this discussion today. But for the rest of the talk today, I'd like to focus more so on this idea that beliefs about potential growth are a main driver. So we can see some support for this idea just by looking at, very simply, the paths of real output, which are shown here on slide 3, again, for the same set of countries. So what we see here is that output growth in the US, which is this dark red line at the top, since the pandemic has been far more resilient when compared to other advanced economies. So at this point, I'd say, again, this is eyeball econometrics here, but I'd say that we're at least on the pre-COVID growth trend, if not ticking above it slightly. Whereas for the other economies in this chart, that doesn't seem to be the case. Much of this is due to the truly unprecedented amount of fiscal stimulus, particularly direct support to households, that we saw during the pandemic. And indeed, while I'm not showing it here, the differences are even larger if we look at the personal consumption component of GDP. Indeed, a lot of this gap in growth experiences really opened up over this past year, and more so during the summer and fall, corresponding to the time when US yields really started taking off. The fact that the economy remained resilient even after the very large and very steep increase that we've seen in policy rates since March 2022, I think really made people, and here I don't just mean policymakers, start wondering whether the neutral rate, or R star, which had been trending down for a long period of time, might now indeed be higher than we thought. So against this backdrop of the possibility of a higher R-star, combined with policymakers increasingly stressing the data-dependent nature of policy, markets have become more attuned to incoming data. So slide 4 here shows some early evidence of this. So each of the 6 charts here plots one-day changes on the vertical axis in 2- and 10-year yields, along with an estimate of the 10-year term premium against surprises in indices of labor market and inflation data releases on the horizontal axis. The lighter dots that you see, so it's the inflation on the top and labor on the bottom. The lighter dots in the fitted lines reflect the relationships prior to this past July, while the darker dots and fitted lines show the observations since July. In all of these cases, we see larger market reactions to US macro data releases in the past few months compared to our historical experience. So this increased sensitivity might then be a factor in both the overall change in the level of the yields, as well as the increased volatility that we've seen recently. One reason that I think recognizing the role of data releases is important is that I believe that this is ultimately tied to the key questions of whether the increase in yields is reflecting some exogenous tightening of credit conditions, for example, a repricing of risks, which may be more of a substitute for tightening by the Fed, or whether it's really endogenous to the economy and to the Fed's actions and communications. So the final slide that I'll be showing today lays out some of these arguments. Here, I'm again focusing just on the increase in yields from July through the end of October. Over this period, as I'm sure you are all familiar with, much of the increase has been chalked up to rising term premia. In fact, the estimate from D'Amico, Kim, and Wei, their decomposition, which is shown in the chart on the left, is one of the most conservative in this assessment, attributing just over half of the yield increase to term premia. If you look at other estimates, they tend to attribute a lot more to term premia. At first glance, it might be tempting to think that the rise in term premium is something that may stick around even if there's a change in the policy stance, thereby being more of a substitute for what policy is doing. However, we have some suggestive evidence that this isn't the case. So the right chart decomposes just the term premia itself into the changes that occurred on days of data releases. And here I've importantly also added a navy bar at the bottom for Fed events, which include the policy announcements, minutes releases, and speeches made by Chair Powell. So what we see here is that even within the term premia, a large fraction of the increase happened on days of either data releases or Fed events, as opposed to the all other days, which is in the light gray bar there. And I'll add that we can draw the same qualitative conclusions if we look at other term premium estimates, or if we also include the recent pullback in yields over the past month. So, of course, this is extremely a simplified analysis, and it's still very preliminary, but it's just one very basic way of trying to shed some light on the questions of the degree to which recent movements in yields are influenced by Fed policy and the economy versus being a substitute for Fed policy, and whether we can expect recent movements to persist. So looking forward, there are other important questions as well, such as the impact that fluctuations in yields will have on the macroeconomy, and I'm looking forward to the rest of our discussion today.
Thank you for that. Fantastic.